All right, we'll go ahead and get it started. And good morning. Wanted to get the little handout here. Hi, Katie.
Hello, thank you.
And welcome to Man in the Morning. And investing basics we're going to talk about. That was kind of the title that was thrown out there, and I think I had the option to make a change to it, but I didn't, so we just got Investing Basics as the title, but we will talk about investing. We're really going to start out more scriptural principles and those kinds of things, and then we'll get into practicals at the end, and I think the idea to keep it pretty basic, but certainly questions afterwards. We can get a little more into the weeds and give you some of my thoughts. So my name's Rich Farkas, and just by background, I started out out of college in banking, and I ended up at a brokerage firm. I thought that'd be more interesting than used car loans. So I went that route, and back in the late 80s, got my licensing, securities licensing. Been at a few different firms. Most recently, I worked at Charles Schwab and was a manager and financial planner at Charles Schwab in the 90s and the early 2000s. Did a lot of work I worked for a company where we sold 401k plans, and that kind of went that direction for a while. Now I'm at UBS Financial Services, my day job, and I'm with part of a practice, and my day-to-day is more focused on 401k plans. So that's kind of my orientation. I've done a little bit of everything over the years. I am a certified financial planner and got some other little designations as well. But again, good generalist, I would say, and pretty good handle on the basics of investing and the planning side. So I think everybody's got one of these sheets. So we'll get started with that. So again, going to start out with just some of the a lot of scriptures and some principles. So on this sheet, I put some of my favorite scriptures, but I'm going to give you some more, and so you can write. Hopefully, there's plenty of room to write on there. Again, the first half is hitting a lot of these from a spiritual standpoint, and then we'll get into some practicals, and they're both fun, right? So, all right. So the next. Get the slide to advance here. There we go. So one scripture I wanted to start out with, and again, no need to turn to these unless you want to, but Haggai chapter 2, verse 8. And just talking about kind of our perspective on investing and assets and those types of things. In the Bible it says, verse 8, chapter 2, actually, I'll go back to verse 7. It says, I will shake all nations, and what is desired by all nations will come. And I will fill this house with glory, says the Lord Almighty. The silver is mine, and the gold is mine, declares the Lord Almighty. The glory of this present house will be greater than the glory of the former house, says the Lord Almighty. So I wanted to kind of start out with the ownership question. And just, again, we really see that all in the world is God's. We're temporary, and the silver is His, the gold is His. And really, we'll look at some other scriptures here that just talk about the aspect of being a steward. I kind of want to talk about that. I think that's really what the Bible implores us to do, and really advises us to do, that we're entrusted with assets or the stewardship of assets, but ultimately we'll see when we pass away, we're not taking anything with us, as we know. So there's a lot of scriptures to reference that. And if we look over let's look at Matthew 25. Okay, Matthew 25, verse 14. Again, it will be like a man going on a journey who calls his servants and entrusted his wealth to them. To one he gave 5 bags of gold, to another 2 bags, and to another 1 bag, each according to his ability. Then he went on his journey. The man who received 5 bags of gold went at once and put his money to work and gained 5 bags more. So also the one with 2 bags of gold gained 2 more. But the one who received 1 bag went off, dug a hole in the ground, and hid his master's money. After a long time, the master of those servants returned and settled accounts with them. The man who had received 5 bags of gold brought the other 5. Master, he said, you entrusted me with 5 bags of gold. See, I've gained 5 more. His master replied, well done, good and faithful servant. You have been faithful with a few things. I will put you in charge of many things. Come and share your master's happiness. The man with 2 bags of gold also came. Master, he said, you entrusted me with 2 bags of gold. See, I've gained 2 more. His master replied, well done, good and faithful servant. You've been faithful with a few things. I will put you in charge of many things. Come and share your master's happiness. Then the man who received the 1 bag of gold came. Master, he said, I knew you were a hard man, harvesting where you've not sown, and gathering where you have not scattered seed. So I was afraid and went out and hid your gold in the ground. See, here is what belongs to you. His master replied, you wicked, lazy servant, so you knew I harvest where I have not sown and gather where I have not scattered seed. Well then, you should have put my money on deposit with the bankers, so that when I returned, I would have received it back with interest. So take the bag of gold from him and give it to the one who has 10 bags. For whoever has will be given more, and they will have an abundance. Whoever does not have, even what they have will be taken from them. And throw that wicked, worthless servant outside into the darkness, where there will be weeping and gnashing of teeth. So this is kind of that stewardship concept, again, of I think God wants us to just do our very best, but to be prudent, and to be not lazy, but to have focus. I know last week in the class there was the scripture about the know your flocks, or know the I forget what was it?
The condition.
Condition of your flocks. Very good. So again, that's what we're really tasked to be, is stewards, recognizing that everything is God's, but we're entrusted, and God's given us abilities. He's also given us a lot of resources. So there's really not the excuse. And even though bar was very low, I see here, for the one servant with the 1 bag of gold, he could have at least, like the master said, at least have it with the bankers and some interest. You didn't need to double it necessarily. He knew, the master knew that servant didn't have the skills or maybe the ability of the others, but he wanted at least an effort and that heart of being the steward. So one of the concepts that I've run across over the years, just even in the secular world, the idea of stewardship is that we're not required to necessarily be experts, but we're, that's where we get help and hire experts. So again, I think we see this in Matthew 25, where the really the servant is tasked with not being an expert, but hey, at least give it to the bankers and get some interest. He wanted some return, and that's really the point. So we'll kind of get back to that when we get into some practicals about, you don't have to be an expert, but there are experts out there. Don't just kind of blow it off, but we're expected to find some experts, and it can be pretty easy. We'll get some practicals there. So to invest, this is just from the dictionary, I'll just read this. To invest is to allocate money or sometimes another resource, such as time, in the expectation of some future benefit. In finance, the expected future benefit from investment is a return. The return may consist of capital gain and or investment income, including dividends, interest, rental income, etc. So again, the idea being that there's some sort of a future benefit that will be received by investing. And again, that's what the master was expecting there. in Matthew 25. So, again, just kind of focus on being a steward. I know that's helped me contemplate things, and I think none of us are going to probably make perfect decisions all the time. I've made investments I've made money on. I've made investments I've lost money on. I can, without getting too much into the weeds, even a conservative strategy. I had a conservative strategy, so we were using options, stock options, and we were writing puts and doing these different things. And again, well thought out. I wasn't running the portfolio, another person was running it. We probably had 20 wins, and you're really just collecting some premium. You're kind of, Mark's nodding his head because it's insurance. Basically, I'm selling insurance. But we had one that went against us, wiped out the profit of the other 20. But I didn't really lose money, but it was a lot of effort to get back to zero. So again, you'll have some things maybe that don't work out, at least in the short term, but we want to be stewards and we want to do our very best and be educated. Okay, so let's go on. Anybody know who this is? Gordon Gekko. So yeah, we're dating ourselves. This was from the movie Wall Street, back in the 80s when we had the big. There was in our society at least a period where it was kind of greed is good, and Gordon Gekko was the big mergers and acquisitions wheeler dealer, and in the movie Wall Street, the original one, Charlie Sheen plays the young stockbroker, and kind of is being mentored by Gordon Gekko. But one of his sayings was, "Greed is good. Greed is good." And there was a little bit of element of that. Even in our society, more so, maybe a little more so than today. But we'll look at some scriptures here. Let's start out with 1 Timothy 6, verse 9. One of the ones there. All right. Faster here. He says, "For those who want to get rich fall into temptation and a trap and into many foolish and harmful desires that plunge people into ruin and destruction." So we have a lot of warnings here. I'm going to go to, let's go to Luke chapter 12. Okay, and I'm actually I've got 16 there, but we'll go to verse 13. So Jesus is there, and someone in the crowd said to him, "Teacher, tell my brother to divide the inheritance with me." Jesus replied, "Man, who appointed me to be a judge or an arbiter between you?" Then he said to them, "Watch out, be on your guard against all kinds of greed. Life does not consist in an abundance of possessions." And he told them this parable. The ground of a certain rich man yielded an abundant harvest. He thought to himself, "What shall I do? I have no place to store my crops." Then he said, "This is what I'll do. I'll tear down my barns and build bigger ones, and there I will store my surplus grain. And I'll say to myself, you have plenty of grain laid up for many years. Take life easy. Eat, drink, and be merry." But God said to him, "You fool, this very night your life will be demanded from you. Then who will get what you have prepared for yourself? This is how it will be with whoever stores up things for themselves, but is not rich toward God." So here we see, kind of hitting this concept of greed, that this is a pretty big deal. How many times in the Bible does Jesus say, "Watch out, watch out"? In the King James, I think it's "take heed." So really, as we know in our Bibles, a lot of the Bibles have, anything Jesus says is in red letters. When Jesus says, "Watch out," to me that's a red letter of the red letter. I mean, Jesus is saying, this is really a big deal. It's a big deal. So it is kind of going along with that concept of us being stewards. This is, he's really reminding, and it's easy to lose sight of the fact that, hey, this really isn't my money, really my money. I'm a steward of the money. for the benefit of my family or other responsibilities that I have. But I can't be greedy about this. And we see the guy here, when Jesus tells the parable, what was the guy's mindset here? It was all about himself, wasn't it? He says, hey, hey, I'm doing pretty good here. I'm going to go ahead and I'm going to tear down and build bigger barns, and I'm going to store all this grain, and then I can just do whatever I want to do, basically. I'll take it. I'll eat, drink, and be merry. No thought to God, no thought to other people. So it's okay, I believe, as stewards, we can grow. As a matter of fact, we see the encouragement with the servant to the master in Matthew 25. It's okay, but by not having that perspective of, when I grow the money, it's really for my master. It's for God and other responsibilities, other people. And, sure, yeah, I can enjoy some of the fruits of that as well, but not have this heart of just really being greedy. And, hey, this is all about me. So definitely, that's one I wanted to hit on pretty hard there, just from the standpoint of that warning that greed's not good. The Bible's very, very specific about that. So got some other scriptures here. Let's see, we looked at that. 1 John chapter 2, I didn't have on the sheet. Just talks about not loving things. 1 John chapter 2, verses 15 through 17. Actually, I'll read that. That's really good. 1 John chapter 2. Do not love the world or anything in the world. Anyone loves the world, the love of the Father is not in them. For everything in the world, the lust of the flesh, the lust of the eyes, and the pride of life comes not from the Father, but from the world. The world and its desires pass away, but whoever does the will of the Father lives forever. So really, we're not to love things. Everything in the world it's just the world. It's temporary. We're not to love that. We're not to be greedy and consume with those kinds of things. Some other scriptures, Hebrews 13, verse 4, Matthew 6, 19 through 20. I'm going to read that one.
What was the last one again? I'm sorry.
Matthew 6, or Hebrews 13, 4, Matthew 6, 19 through 20. Do not store up for yourselves treasures on earth, where moth and vermin destroy, and where thieves break in and steal. But store up for yourselves treasures in heaven, where moth and vermin do not destroy, and where thieves do not break in and steal. For where your treasure is, there your heart will be also. So I believe this really ties in a lot with what Jesus' concern was. Jesus' concern was, who's really your God? Where is your treasure? Is it in things? Is it in your wealth? Is it in your 401k? Or is it in spiritual things? Recognizing that our treasure shouldn't be in earth. It should be in heavenly things. And then Luke 18, verse 22, the rich young ruler. We're not going to look at that one, but he went away sad, didn't he? Because I think Jesus knew, the guy had been a good religious guy, but his real treasure was there in those material things. And Jesus tested him, and he went away sad. So, again, the greed thing, I've just found that to be a theme throughout the scriptures, to really be very, very careful with that. I know that's something in my business, I've had the opportunity to be around money a lot. I've seen very high net worth. We've got some clients worth over $50 million. And we're not even really, we're not New York City or anything, so that's kind of a big deal. And around a lot of that kind of, little bit of the wheeler-dealer type of thing, and I have to watch it a lot. I have to watch when the market's just going up, and I'm like, I'm going to look at all my accounts every day, and I have to kind of be careful. I'm preaching myself here a little bit on this topic, but again, I think we get a good handle on this. We understand how we're to think about it. We'll be well served. I'm going to go ahead and move on to the next one. just a little bit more, some scriptures here, and then we'll get into the practicals. How does God view investing? So we really see in the scriptures, really the idea of storing up is okay. And look here, we'll look at Genesis. A couple of these scriptures here, and I'll give you some more. All right, so Genesis 41, starting at verse 47. During the 7 years of abundance, the land produced plentifully. Joseph collected all the food produced in those 7 years of abundance in Egypt and stored it in the cities. In each city he put the food grown in the fields surrounding it. Joseph stored up huge quantities of grain like the sand of the sea. It was so much that he stopped keeping records because it was beyond measure. So we see the idea of storing and planning for the future, being a godly pursuit, and certainly Joseph was uniquely put into that position by God to, during the 7 years of plenty, to store up an additional 7. So above and beyond just taking care of the immediate needs, storing up for the future, and doing that wisely to the benefit of the people as God would allow. So, and God not only allowed, He permitted it to happen, wanted it to happen, and would use it for His purposes later. So really we see the 7 years, we're essentially kind of doubling the amount of grain for the times of famine. So that's okay, that's permissible and good. Let's go to... all right, let's see. Not sure what I was doing there. There's a ton of Proverbs, and we're going to look at the Proverbs. A lot of really good ones. I have a few others to give you here. I've used the Proverbs a lot over the years, again, to have the money concept, very, very helpful. So Proverbs 13:11. Dishonest money dwindles away, but he who gathers money little by little makes it grow. And this, we have the slide here, growing it little by little. For most of us, that's how we're going to accumulate wealth. That's how historically, most people have accumulated wealth, is little by little, putting that money away and having a prudent growth plan that makes sense. And then having those assets down the road. And that's really, I think, what the hallmark of investing is. In the 401k world, that's one thing I really like about working with 401ks is I get to work with, blue collar person as well as executives, but help them do this, use their 401k for part of their retirement. To me, it just makes sense. It's a great way to have just a little out of their paycheck every time. And some of these folks without that really wouldn't have a retirement, just barely getting by on Social Security. So little by little, verse 22 there, a good person leaves an inheritance for their children's children, but a sinner's wealth is stored up for the righteous. We kind of see again, I think in the Jewish mindset, leaving an inheritance was a wise thing to do. And we see that, commended in the Bible. So, retirement and maybe, leaving something behind for those who would come. Now, again, a little different society back then, obviously. But the greedy guy that we read about in Luke 12, it ends up that money goes elsewhere. He had no family. He was only out for himself. And we see that again. The sinner's wealth is stored up for the righteous, that eventually it makes its way to folks doing more what God would have them to do. Go to Proverbs 21. So these are some of the ones here already on the sheet. The plans of the diligent lead to profit, as surely as haste leads to poverty. Basically, just have a plan and a prudent investment approach. Again, God looks at it that way. And then 21:20. The wise store up choice food and olive oil, but the fools gulp theirs down. In today's society, I look at that as, we want to have some extra. We want to have, some of the things like Mike Foley talked about, and we've had available in the Financial Peace from time to time, getting on a good budget, getting rid of debt such that you can save, and rather than just living check to check. Ultimately, I think the person who gulps down all their food, they've not stored anything up, and they're just that's the living check to check in today's society. So God does view that it's wise to store up and investing opportunities that are available today. All right, we'll look at Proverbs 30 and 24 through 25. 4 things on earth are small, yet they are extremely wise. Ants are creatures of little strength, yet they store up their food in the summer. And so on. So again, that's a good verse there to remind us that's wise. God views that as wise. 1 Timothy 5. In verse 8. Anyone who does not provide for their relatives, and especially for their own household, has denied the faith and is worse than an unbeliever. And certainly savings being a part of that, retirement savings, and I think life insurance you could throw in there as well when the kids are younger, and having a plan, being wise. But on the investing side, certainly having some assets is wise and commended. We see that. All right, 1 Timothy 4, okay, we did that. Ecclesiastes chapter 5. And we'll kind of wrap it up here a little bit and get into some of the practicals. You guys are hanging in there with me very well.
All right.
All right. Ecclesiastes 5. I have seen a grievous evil under the sun, wealth hoarded to the harm of its owners, or wealth lost through some misfortune, so that when they have children, there's nothing left for them to inherit. Everyone comes naked from their mother's womb, and as everyone comes, so they depart. They take nothing from their toil that they can carry in their hands. This too is a grievous evil. So again, a wise approach to investing, and we'll talk a little bit about that in the practicals. But I'm not a believer in speculation and things like that you have to be really, really careful. Maybe a small portion of money for those kinds of things. Let's see here. One other, I'm going to throw another one here that I was thinking about that I think is very good. Luke chapter 4, and we'll kind of wrap up some of the spiritual aspect of this. Luke chapter 4, verse 5 through 7. This is actually Jesus being tempted by the devil. The devil led him up to a high place and showed him in an instant all the kingdoms of the world. And he said to him, I will give you all their authority and splendor. It has been given to me. I can give it to anyone I want to. If you worship me, it will all be yours. Isn't it interesting that even Jesus, Satan thought he could tempt him with all the kingdoms of the world, all these material things. All this can be yours. Satan probably, hey, it's worth a shot because these things really are appealing. This greed thing, can really, it might have a shot with Jesus. It ended up, of course, he did not fall into that. But that was a big temptation. So we just need to kind of keep that in mind, that can happen to us too. All right. So let's get into some practicals here. Okay, so practicals. Stocks, bonds, and cash. Stocks, bonds, and cash. We're going to keep this pretty basic. So really there are, in the investing world, I'm starting out with stocks, bonds, and cash. We'll talk a little bit about real estate and some other things, but from an investing standpoint, let's say for retirement, again, in a 401k, in a IRA, which is an individual retirement account, the three main areas are going to be stocks, bonds, and cash. Stocks, very simply, are publicly traded companies that will trade on the big exchanges. So they can trade on the New York Stock Exchange, NASDAQ. They can trade on international exchanges, potentially. Again, London or Frankfurt or Hong Kong, big exchanges, Tokyo. And these are, sometimes we hear about, the Wall Street casino. Well, I beg to differ with that a little bit. Really what you're doing is you have a small piece of ownership in companies, in companies through the stock market. So you own a piece of that company. So it could be Eli Lilly, it could be Apple, it could be Facebook, Netflix, Procter & Gamble, Coca-Cola, Walmart. Okay, so you really have ownership in that company, and that company can be making money, and you really want to have good companies. So we talked about the steward hires a good manager. Doesn't have to be the expert and go out and buy stocks. We'll talk about mutual funds in a minute, but what you're doing through mutual funds, you're hiring a good manager and being prudent in that way. Stocks can go up and down, and we'll talk about that. It's also your best opportunity for growth. So really for long-term goals, let's say at least 5 years out, 10 years out, retirement, 20, 30, 40 years out, stocks should be a part of that to the degree that makes sense and that's right for you as an individual. So those are stocks. Bonds are IOUs of governments and corporations. You are essentially becoming the bank. You're going to Uncle Sam, and Uncle Sam issues a 10-year treasury bond, and they say, we'll pay you 3% if you'll lend us the money for 10 years. We'll pay you 3% a year. So we give Uncle Sam $1,000. We're getting 3% a year, and then in 10 years when the bond comes due, we're getting our $1,000 back. So bonds are a good investment for maybe a portion of your money. Bonds are not going to have the appreciation that stocks will historically. We'll look at some charts here, but they tend to not be quite as risky. Now bonds, the values of bonds can go up and down as interest rates change. So if a bond was issued in a low interest rate environment and interest rates are a lot higher, new bonds are going to have a higher interest rate. Your older bonds won't be worth quite as much. But again, we can hire managers to do that, bond fund managers. They'll buy and sell the bonds and they'll adjust accordingly. And really with the mutual fund, we will have that interest reinvested in more shares of the fund. So that's how we make money. Bonds also are a shock absorber for the stock market going down. We'll talk about that in a minute. And then cash is really not cash. It's like a savings account. So you get some interest, but a lot of times the interest is not going to keep pace with inflation. Okay? So again, cash is not just sitting there like, cash in a suitcase, right? But it is, getting some kind of an interest. Interest rates are going up on cash. So if we look at this chart here, this is Ibbitson's a research firm that does a lot of Wall Street research. And this slide really is going to go back to prior to the Depression, so a really long time frame, and through the end of 2015. So fairly current. I like the fact that the Depression's here because it does remind us there are bad periods. We will have 2008 here. We've got 2000 to 2002 here. We have some bad markets. So the colors are a little messed up here. I'll tell you the one at the top is small company stocks. These are going to be big company stocks. These are going to be bonds. Cash is the purple line. And then inflation is this filler in here. So the idea being in the long run, really what you would like to do is invest in these three areas here. where we've got some small company stocks, large company stocks, and some bonds, and that is diversification. So the returns, again, might be a little hard to see. During that period of 1926 to 2015, small company stocks were up 12% during that period. Large company stocks were up 10%. Government bonds, 5.6. Treasury bills, so this is the cash. Treasury bills are just a 3-month interest-bearing treasury obligation. They call it a bill. 3.4%. You can't get that today. And inflation during that period, 2.9. So that's a little danger of cash being illustrated there. We can actually see periods where the cash was under inflation. And that's actually what we're in today, where we might be able to get something approaching 1% in cash with some restrictions to it. Well, inflation's more like 2.5%. So really, by the time you get that return, kind of like the servant, the master said you should have at least had your money on deposit with the bankers for some interest. Well, that approach really for long term is not really the best approach in most cases, because it's not going to keep pace with inflation. But very interesting that $1 back in 1926, at the end of 2015, worth over $26,000. Pretty nice. $1 in large company stocks, $53.90. $1 in bonds, worth $1 or $132. Now again, $1's worth of groceries in 2015, we would have needed $13 to buy the same amount of groceries. So that's inflation, okay? The sheet I handed you here, and we'll kind of wrap this up with the practicals. This is going back the last 20 years, a little more current. We'll have different areas of the stock market. We have large company stocks. We have 3 different types. There's a growth style, the value style. The growth is going to be more your Facebook, Netflix, biotechnology, that style of investing for big companies. The value style is going to be the boring companies that pay a dividend. That's your Coca-Cola. Good companies, they're just, a different style of investor typically. And then the green, the large cap core, combines the two. So if you were going to own just one area, you would own large cap core because it combines the two. And you'll normally see it in between on the performance of large cap value and growth. Small company stocks, international stocks. Bonds on this handout are the fixed income. Fixed income is bonds. And then cash is your 3-month treasury bill. The orange box is the diversified portfolio. So this is what we recommend, that in your big picture, of everything combined, that you want to have a little bit of everything. You want to have some bonds as a shock absorber when the market's down. You want to have different areas of the stock market. The reason we say that is there's no predictable pattern on this sheet. If there is, if you see one, let me know. We'll talk afterwards. But there's no predictable pattern. I don't know what's going to happen the rest of this year. Growth has still been pretty good this year in small companies. But eventually value is going to be back in style. But I could put all my money in one area of the market and I could be wrong. We don't want to do that. We want to put a little in all areas and then just let it ride and adjust it a little bit here and there. This orange box here, again, these are indexes. They're not managed. They're just whatever that index is in that particular area. 65% in stocks, 35% in bonds. The part that's in stocks is spread out in the different areas. So the bad news is you're never at the top. The good news is you're never at the bottom. In a real bad year like 2008, you got some cushion. The market's down 37%. You're only down 23%, which means the next year you don't have to come out of a hole that's as deep as your friend that's all in stocks. Turn this over during that 20-year period, and again, we see some really bad markets, don't we? 2000, 2002, the tech wreck and Y2K and all that, a true recession, and then 2008 was the real estate crisis. we still ended up during this period with positive returns. That diversified portfolio actually beat two individual areas of the stock market, large cap growth and international, and did it with less risk. If we look at flipping it back again, the roller coaster ride, a smaller roller coaster ride, we'd like to get close to market returns, and we're close to 7% with that, and I think that can be doable going forward. Probably not going to see unfortunately, the 10s and the 12s anymore on a long-term basis. Certain individual years, yes, we will. Ecclesiastes 11:2. I'll just read it. It's on the sheet there. I know we're starting to need to wrap up here pretty quick. All right. Invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land. And I think that's, talking about diversifying in your ventures. Don't just double down on one venture. We want to diversify and have different areas. And I've found that to be true in my years, where I've had some winners, I've had some losers. So I'm glad I had diversified so that I had some winners when I did have that losing situation. Mutual funds. Mutual funds are the way to do that. We've referenced that a little bit already, but we're hiring the manager to do that. Your 401k plan will certainly have mutual funds available, almost certainly, or the equivalent of a 401k if you have a 403b or 457. Those are plans today, much like a 401k. Mutual funds hire the experts. I'm a big believer in Morningstar. I'm going to write that down. You can just go online, morningstar.com. There's a 5-star rating system. I want something to be at least a 3-star. I really like a 4 and a 5. If something's a 2, it better be pretty good. There has to be some kind of reason why I would hold that fund. And definitely a 1, I would fire it immediately. But the 3 can be in the middle of the pack. It might be a lower risk. It could still make sense. But 4s and 5s are what I look for. I look for, I don't focus on the 1 and the 3-year returns as much. I'm looking at 10-year returns and 5-year returns. Definitely 10s. Again, I'm looking at the long term. I want a manager that can be a 4 or a 5, and I like to have lower risk, low fees. I like active managers. Active managers are where they're trying to beat the market, they're trying to beat their index, but you're going to pay more for that. So I have some index funds as well. I kind of do both. And normally active managers can beat in small companies and international and bonds.
I was just saying you might want to explain what an index fund is.
That's great. An index fund is basically taking an index for that particular area of the market, and they're just going to passively manage it. They're going to, basically something you and I can do with a computer. Look at that index, and we're going to buy the stocks. If it's the Standard & Poor's 500 index, we would just get a list of the 500 stocks, and we would go out and buy those stocks proportionate to the way they're in the index. So we would have to manage it because things would change here and there, but minimal management. So they call it passive management. An actively managed fund would be, let's say, Corey and I, we're going to run this, and we're going to say we're going to buy 80 stocks, but we're looking for a certain strategy. We're going to buy, biotechnology, or we're going to buy, growth stocks, and we think we have a strategy to beat that particular index. Sometimes we will, sometimes we won't, but that's going to be more expensive because we have to pay our salaries and do more research than just tracking the index. Okay? So again, I can help with some of these things offline as well. I will say in retirement plans, a good approach can be target retirement date funds. And you'll see if you have them in your 401k, you can even do this for college plans as well, 529 plans. But it's targeted to a particular year that you think you would retire or that your child would go into college. So for the young baby, we're talking 18 years out, 20 years out in that time frame. Today we would have more in stocks. As we get closer to graduation or retirement, we move more into bonds. So what they're gonna do, they're gonna do the orange box approach. Let's say I'm 45, I'd probably go into a target retirement date fund that would have 2040 in the name, because it's gonna be somebody retiring around the year 2040. So it's 21 years off, essentially. So if my 45-year-old would retire at 66, thereabouts. Today, probably about 80% in stocks, maybe a little more. But as we get closer to the year 2040, gradually shift more into bonds. Probably by the time 2040 comes around, about 45% in bonds, or 55% in bonds, 45% in stocks. They still want to have some in stocks to keep pace with inflation. But those could be an easy button, one-stop option there. Real estate, there are some mutual funds. I didn't include that in my basic category. That would be, I include that in the stocks portion. There's some real estate funds out there. It can be a little different area of the market that doesn't go up and down along with the regular stock market. They will typically invest in what are called REITs, real estate investment trusts, like Simon Properties, the big mall, the Simons in town here that own the Pacers. So that is a little subset of these asset classes here. I'm really not into speculation. I think some people maybe understand the blockchain technologies or gold or things like that. I would, if you know what you're doing there, you really study that, follow that, I would not have more than 10% of my money in those very targeted areas. I would have that as kind of my explore area, a little more of a speculation than this basic strategy that we're talking about here. Last but not least, this is kind of cool, the Rule of 72. I think we got enough of these. This is kind of a, pass this down. This is kind of a neat rule. They help you understand doubling, double your money. How long would it take to double your money? This is kind of a simplified formula. So basically, if you know the rate of return you expect to get, you could divide 72 by that rate of return, and that's going to tell you how many years it will take to double your money. So if I think I'm going to get 8%, I divide 72 by 8, it's going to take me 9 years to double my money. If I'm getting 1%, I divide 72, it's going to take me 72 years to double my money. Again, that kind of knocks out the cash approach, just getting a money market rate. On a long-term investment, it's not the approach to take. So kind of interesting there. You can use that maybe at the holidays with your family or whatever. Ask them what the Rule of 72 is. But it's a neat, again, God's wisdom in growth and compounding. It's a snowball effect. You're getting interest on your interest or return on your return. So every year, let's say if you're getting 7%, the next year your dollar is now up to $1.07. You get 7%. You're getting 7% on the extra 7 cents, and then that compounds and grows over the years. Amazing how God does things. So I know we got to start a little late. I'm going to wrap it up here. Any general questions, and then I can stick around. Yeah.
If you put like real estate in this graph, where would be like relative to the other investments?
Real estate.
Yeah.
So real estate would typically be closer to the large cap, I would say in between bonds and the large company stocks. And because their interest, those types of investments, and I'm not talking about going out and buying a plot of land, I'm talking about investing in real estate, income producing properties. They will kind of behave kind of in between a bond because they have fixed rate of interest a lot of times or return of principal baked into it. So that's a good question. And the reason sometimes that's used as an allocation just to further diversify and slow down the roller coaster ride, make it even smoother.
Just generally, I've had the question a few times, like how much money do I need to feel good about retiring? And I know that that's not the same for everyone, but maybe you could speak to how you answer that question when that comes up.
So that's a great question. So what I would do, again, along the theme of being a steward, I would get to the point where you do some planning around that. And maybe that's the initial question, is to think about it. Very, very, very general. I would want to have 10 times my final salary saved up by the time I retired. If I was making $50,000 a year, I'd want to have $500,000. In addition to Social Security, very likely I could have a similar lifestyle.
Unless you have like a
Pension.
When the company pays you when you retire, I forgot what it's called.
Yeah, so a pension plan, and that's why looking at a plan, we'll take all these things into consideration.
Yeah.
So somebody that had been in the military or fortunate enough to have a job with a pension, then that would enter into it. Still wouldn't hurt to have the 10 times.
Right.
If you were able to do that, you'd have more choices. That is way oversimplified. That would still assume that Social Security is in the picture. If you don't think Social Security is in the picture, you would want to have more than that. So that's where doing some planning prior to retirement, and especially as younger people, I would save. And I know, the Dave Ramsey, getting to where you're saving anywhere from 10 to 15% of what you make into retirement assets. You have a good shot of getting there, and then planning around that.
Just to kind of tie in some of the things that I talked about earlier, is I think when you're trying to do the things that you're describing here, it can be overwhelming, but to the extent that you can get yourself out of debt, car debt, home equity loan debt, those kind of things, you're kind of trying to do this with weights around your ankles when you're trying to invest in this stuff when you still have all this other debt. So that's why I'm a big proponent of, if you can get to the point where all you have is your mortgage, you're going to make a lot more headway in this area. And if you can get to the point where you don't even have a mortgage, it's amazing how quickly this can happen. So.
Mm-hmm. Yeah, I think that's great. We're kind of assuming, talking about this, that thought has been given to that, and there's a plan. Again, looking around the room, probably most of you are not, in a horrible situation, but that's exactly right. You have to attack that first to really be able to juice up these retirement assets to get to where you want to be. So, any other group questions? All right, well, thank you, guys.
Thank you, Rich.
Thank you.